The Philippine transfer taxes. The transfer taxes imposed by our government may either be estate or donor's tax. What is common between estate and donor's tax is that these are imposed on gratuitous transfers. Remember your obligations and contracts. A contract may either be gratuitous, onerous, or remuneratory. When we say gratuitous, the other party is not giving any valuable consideration out of the contract. It is being given out of pure beneficence. As opposed to onerous or remuneratory contracts. For onerous contracts, both parties are giving a consideration. Now, if it is service and the other party is now being paid commission, compensation, or fees for the services rendered, that is remuneratory. Now, what is the tax consequence? Let us apply it in taxation. If the transaction is gratuitous, it will be subject to Philippine transfer taxes, depending on the mode of acquisition of ownership. In Article 712 of the new Civil Code, there are several ways on how a person acquires ownership. It may be by occupation, by tradition, by testate or intestate succession, by donation, by prescription, but there are now several ways on how we acquire ownership. Remember, if now it is by virtue of a gratuitous transfer, subject to Philippine transfer tax. However, if it is onerous or remuneratory, it may be subject, it may be subject to income tax. If there is a taxable gain, it may be subject to income tax. Now, estate and donor's tax are both excise or privilege taxes. These are national taxes. The purpose is general, that means fiscal or revenue purpose of the government. And as to valuation ad valorem, because this is based on the amount of the subject or object of taxation, based on the amount of the estate or amount of the donation. Fair market value at the time of death and fair market value at the time of donation. And with respect to tax rates, at present, under the train law, estate and donor's tax are already using the proportional tax rate of 6%. We already have uniform tax rate for estate, donors, and capital gains tax. Unlike before, estate and donors are adopting the schedular, progressive. We have a tax table. For donors tax, it is a combination of progressive tax rates and proportional tax rate because we distinguish or differentiate a relative from that of a stranger donee. But it has been simplified under RA 10963, and this is our train law, that we are adopting the uniform tax rate of 6%. Now, for both estate and donor's tax, we have same classification of taxpayers, same classification for decedent, and same classification for donor, which may either be resident or citizen, or non-resident, decedent or donor. Yeah? And aside from that, the tax base for estate and donors tax is based on the net. Either the net estate, net taxable estate, or the net gifts. That is why in the course of our discussion, you will see the similarity between these two Philippine transfer taxes. But remember, if the transfer is gratuitous, it is subject to transfer tax. Depending on the mode of acquisition, on whether it is by donation or by succession. Let us illustrate. Macdonald's is suffering from diabetes and he has heart ailment. Because of the community quarantine, he refused to submit himself for medical check-up. He refused to go to a hospital or a doctor. Until such time that his medical condition worsened, leading to his death. Now, Macdonald's left several properties. He has real properties and business interest, bank deposits, leaving behind Manolito as his heir. Now, and the properties, we call it initially, in ordinary parlance as inheritance, right? Inheritance. But as we go along, these properties, the patrimony or inheritance, is the estate of the decedent. Now, the estate or the properties comprising the estate will be transferred to Manolito. But before Manolito can acquire those properties, the estate should pay what we call estate tax. And estate tax is imposed on donations mortis causa. When we say donation mortis causa, it is by succession. And if it is by succession, death is material. The death of the owner of the properties. The death of the decedent. Because succession is transmitted. The right to succession is transmitted from the moment of death. And it is where succession sets in. Another illustration. Macdonald's, while still alive and during his lifetime, donated to Manolito a sports car. This is a gift to Manolito. Macdonald's is our donor. In case of direct donations, let us just assume that Macdonald's has the capacity to transfer ownership. And then he has the intention to donate voluntarily. And this is unilateral to Manolito the sports car. Also, that this sports car has been delivered to Manolito and accepted by Manolito, our donee. But before Manolito can transfer the ORCR of the ORCR, the certificate of registration of the sports car, now there should be payment of what we call donor's tax. And who will pay donor's tax? It is Macdonald's, as the term itself states donors tax. Now, donors tax is imposed on donation inter vivos. This is a gratuitous transfer, a donation made during lifetime, as distinguished to that of estate tax. Another illustration. Mang Tolites owns a residential house and lot in Barangay Wakwak, Green Hills. He acquired this residential real property sometime in 2005 for 70 million pesos. At present, this has fair market value of 150 million pesos. Now, and because of financial difficulties brought about by the crisis, Mang Tolites decided to sell this house and lot to Pepito. For how much? For 130 million pesos. Now, and then they closed the deal. In this case, this involves sale of real property held as capital asset. This is a sale and not a donation. Is this subject to transfer tax? Answer is no. But in order for Pepito to transfer ownership on transfer ownership of this property in his favor, there must be payment of capital gains tax, equivalent to the 6% of the gross selling price or fair market value. The fair market value is the assessed value as per assessor's office or the zonal value as per BIR, whichever is higher. And we will compare that with the gross selling price, whichever is higher. 6% of the gross selling price or fair market value, whichever is higher. Now, capital gains tax is not Philippine transfer tax. This is income tax. And what is involved in this case is an onerous transaction and not a gratuitous transfer. As I told you, if it is onerous or remuneratory, and there is a taxable gain, by the way, in this case, in CGT, it is not only actual, it is presumptive gain. We recognize presumptive gain in CGT on sale of real property held as capital asset. Now, that even if we have, say, personal property and not real property held as capital asset, personal property or even ordinary assets, now, if there is a taxable gain, that will be subject to income tax and not transfer tax. Okay.